Well, let's move on and welcome our next guest on the show. Laurence Balanco from CLSA is joining in. Good to get some perspective now, considering all that this market has gone through over the last couple of weeks. Laurence, great to have you. Thank you very much and good morning to you. So, the Indian market has had its first bout of a mini correction, so to speak, particularly the mid caps and the small caps, though the headline index hasn't lost too much from the top. What do you make of things as they stand here in India right now? How are you reading the charts?
Yeah, so definitely running through the first meaningful correction that we've had since September last year. And we don't think this corrective action's over. We expect sort of volatility to pick up and ultimately both the mid-cap index and the Nifty itself to correct back to its 200-day. What that would mean in relative terms is that Nifty's got roughly 5% downside, but the mid-cap index from current levels still has roughly 10% downside. So we think there is still some relative underperformance, further volatility in mid-caps, while you get some relative outperformance from the large cap side, but both indices running through this correction should ultimately see a test of the 200-day. That's a longer term trend. It doesn't break that structure, but definitely in the short term, expect more volatility.
Well, just a couple of more stocks that I want to mention. One of them is Metro Brands. And, there is a very interesting note that we've got on Metro Brands from Goldman Sachs this morning. So do keep an eye out on that. They've initiated coverage on Metro Brands and on Bata India. Metro Brands, in fact, is now up almost about 6-odd%. They have a buy on Metro Goldman Sachs with a target price of 14.50, which is well above the current market price. And on Bata, they have a neutral with a target price of 14.70. So Metro Brands is a big mover this morning. Laurence, hi, good morning, and thanks for joining in. So, just to get some targets out of the way before we move on to other big technical trends, on the Nifty itself, do you think this 22,000 mark is something that could be a struggle for a while? And by the end of this calendar year, what are you looking at as both the floor and the ceiling for this market?
Yeah, so our base case is that this current correction unfolds down to the 200-day moving average, and that's basically around the 20,200. It will be slightly grinding higher even if we run through this correction. So we're looking at about 20,200 to 20,300. So that's where we think the floor would be, and a bit of time consolidating around that level. But like I said earlier, it doesn't break that longer term uptrend, and we still got targets sitting around the 23,000 area. So once we run through this correction, longer term uptrend should resume, and then we're targeting moves closer to that 23,000 area.
Yeah, all right. Hi, Laurence. Good to see you in, and thanks so much for joining in. So maybe a pullback to the 200 DMA, and then, in fact, we bounce off there on the Nifty. The sector that's in focus this morning, post that weak guidance coming from Accenture overnight, is the IT index. And you believe that it's breaking down a little bit? Tell us the levels we should track on the Nifty IT index.
Yeah, absolutely. So if you look at that Nifty IT index, it's quite interesting that the recovery rally that you've seen from October lows last year has got basically back to the 2021 highs. That's where we've stalled and rolled over. And to use the sort of chart terminology, you've got this classic head and shoulders top that we broke down from this week. And that gives you roughly 7% downside from current levels. And it does make the IT sector a relative underperformer, particularly if you look at it versus the banking sector or the broader Nifty index. So, what takes the broader Nifty down to its 200-day is essentially the weight from the IT sector. So if you look at Infosys, Tata Consulting, all quite similar topping patterns and breakdowns that you've seen from that.
So, just to complete the point on the Indian market before we move on, Laurence, since you are expecting a bit more of a correction to play out, and 5% index level, 10% mid caps can be, even more brutal for individual stocks. Any advice you'd want to put out there? What should portfolio shifts be like? Would you say some rotation into maybe a Reliance, or I don't know? I mean, if the bank index is looking better off.
Yeah. So obviously through this corrective phase, it's all about relative outperformance. So something falling less, or at least holding its ground. And yes, Reliance does stand out. If you remember that the stock broke out of a 2-year trading range, that you've still got longer term upside targets of 34,000 to 35,500. And this current pullback that you've seen between 2,600 and 2,800 would be, I think, an opportunity to add exposure there. And with that limited downside, it should give you relative outperformance. Within the banking space, I think there's sort of rotation opportunities. Essentially we're having a high momentum correction or a crowded positioning correction. And that's why you've seen the mid caps fall more. And if you look at the banking side, that's why you've seen the state banks fall more than the private bank. So as a relative trade, RCRCI looks like it should outperform State Bank of India. So there's some tactical rotation there. And if you stick with the private banks, I think, again, ICICI is a long and Axis Bank as a short. There's some weakness on that Axis Bank chart too that we've seen there. So again, selectively, there's stocks I think that you can remain long that hold their ground, but there's some stocks that still look vulnerable to further downside. But the message should be stick to the larger cap names through this corrective phase.
Okay, stick to the larger cap names through this corrective phase. Got that. That's an important message. How are you feeling about the global markets now? Because most markets, whether it's the Dow, the S&P 500, even the Nikkei for that matter, are sitting at fresh record highs. Is there more steam to this rally there? And if yes, what are the levels to watch?
Yeah, I think the interesting setup that we're looking at in the US is actually the reemergence of the small cap index post the Fed meeting this week. And we had corrected back to the 50-day before the Fed meeting. We've actually bounced off that. And if you look at, take the extreme of Russell 2000 versus NASDAQ 100, is the relative chart of those two indices have seen small caps actually bottom out in February and outperform. So technically, the upside potential is greater in the small cap space, even with the NASDAQ being in a very well-defined uptrend channel. You can look at some of the mega cap tech stocks like Apple, which is really stalled out, and the $166, $167 area is quite critical for Apple. So if that does break down, that can be a drag on the NASDAQ 100, where you've got this potential re-rating in the Russell 2000. And I think, regionally, one of the issues that India has run into the near term has been its great outperformance. What you're seeing currently with markets like Korea breaking out, some stability in China, is that investors, for a change, have a bit of alternate destinations to look at, because India had been such a dominant outperformer throughout last year. And as we've gone through this year, we've started to see other markets which have lagged started to break out. And Korea is one of those markets that stand out that has got investors' attention and taken away a bit from the India side.
All right, Laurence, just to confirm, the tech index, that's completed a 10% correction from the 52-week high, currently holding around 34,800. The level that you said it will correct to is closer to around 33,000. If you could just help us out with that level.
Yeah, absolutely. So another 7% downside risk. So, it'll take you to almost a 20% correction from that 52-week high that we registered recently.
Got it. All right. Let's talk about one asset class that's been doing quite well, part of the metal index. Let's focus on precious metals first. Gold has been doing well, and all that glitters actually has been gold, off late. Either which ways, if you look at the central bank action, prior to that, there were select central banks that were tanking up on gold. And that gave you a sense that maybe gold will bounce back, as does you have the equity markets that were overheated. What's the levels you're looking at on gold? And if there are any plays with regard to the stock market, whether it's looking at the gold NBFCs, gold, financial lenders here or Titan, any stocks that you could relate to it?
Yeah, I mean, on the gold side, absolutely a meaningful breakout once we finally cleared through that 2100 area. It had been a ceiling for gold price action since August 2020. So the breakout is meaningful. And from that trading range, we get an ultimate upside target of 2,500 to 2,550. Focus more on the gold miners. So I won't give any comments on the sort of derivative plays from a stock-specific basis, but absolutely, gold, we think there's still further to go with this breakout, and 2,500 to 2,550 being the upside target.
Okay, so gold still shining bright, huh? Laurence, finally, so just how do you see things? Because of all the central bank talk, suddenly there was excitement in equity markets, but bond markets are not showing that level of an excitement. I mean, there's been no massive fall in the US 10-year. It's still about 4.2, 4.3. So how do you sort of read that whole situation, the dollar, the US 10-year, and what US equity markets are doing?
Yeah, so good question in that. Yield's quite interesting. As long as we remain stable here, and the key level that we're looking at on the upside is this 4.33 to 4.36. So as long as the 10-year yield stays below that level, we think equity markets can still work. But the key thing is the rotation that we've seen beneath the surface. I think the risk for global equities is if we did see a break above that 4.36% area on the 10-year yield, and we see acceleration in yields to the upside, that could be more of a concern for risk assets globally, and we get then more of a synchronized sell-off in equity markets. So we're watching that closely. Our base case is that we remain range-bound, and having a stable to range-bound in US bond market gives the opportunity for various parts of equities to work with a bit of rotation beneath the surface. The dollar setup is quite interesting. From a longer term side, we think the September 2022 high is a major cycle peak for the dollar. Over the past 12 months, we've been stuck in a range between 100 and 107. Now, we think that range ultimately sets the platform for another leg to the downside. But clearly right now we're sitting in the middle of that range, so quite trendless. But I think both having the 10-year yield as well as the dollar in a trading range lets equity markets breathe and have that rotation opportunity. You don't want these big macro markets trending in any meaningful manner that it starts to dislocate risk assets globally.
Okay, one final question from my end. Do you track the auto index? Because that has been one space that has really been on a tear in the last 6 to 12 months. Any more upsides that you see there in some of the top tier auto names?
Yeah, I mean, it's quite interesting. At the stock level, again, it's getting sort of quite selective. You've had things like Asian Motors roll over, Leland also roll over, but then you had Mahindra with momentum confirming its highs with Maruti Suzuki. So we think you need to get more selective at the end of the day. And then from the index level, what that means is that we're likely to go into a holding pattern and a trading range. That's relative to what we think the Nifty still corrects to, is that we're likely to see some outperformance from the broader auto space versus the Nifty, because the Nifty downside is really driven by that weakness and breakdown in the IT sector.
All right, Laurence, a pleasure speaking to you. Thank you so much for joining us and taking the time out today. Have a great weekend. That is CLSA talking about the markets.